teaching us. Accept our worship now and forever in Jesus' name. Even as we go into these words of finances, teach us your word. Help us to understand better. And let your name alone be glorified. In Jesus' name we have prayed. Amen, amen, and amen. Forgive me if I don't sound like a pastor today. That was wonderful. I will sound more like a teacher and a colleague, like an accountant. Allow me to do. Oh, sorry, financial planner today. Um, I was asked to talk about understanding credit scores, and registered accounts in Canada. The truth of the matter is, those topics are too wild to talk about in 30 minutes. It's a lot of things packed in there. Credit score is, credit alone is about a 1 hour, 3 hours conversation, and you will not get bored. Registered account alone is like almost a week. You won't get bored. So what I did is I created a small barcode there. You can scan that, and you get my contacts, and you ask me any questions, please. So if you scan the barcode, you should get my contact details, and you can reach out to me, and we'll talk more. To the glory of God, my name is Oluwakayode, Samson Ajayi. I don't know how we'll do these slides. Forgive me. Can I get the next slide? I don't know what the person is. Okay, no, it's on every slide. Don't worry, it's on every slide. So at any point in time, you can scan it. It's on every slide. So introduction, I'm a Christian, to the glory of God. I'm a financial planner currently at Scotiabank, which is funny, just your neighbor here. While driving here, I saw Scotiabank. I'm like, oh, I know that branch. And funny enough, my manager works at that branch. That's far too fast for me. Okay. Well, that's my name. They've introduced me already, but it's okay. I have a few experiences to the glory of God. I've not been in Canada for forever. So the experiences is the grace of God and His mercy that has helped us. But the idea is finances is straightforward. It's black and white. So if you know it, you know it. If you don't know it, you don't know it. You might be moving around the corners, but if you know it, you will hedge forward quickly. The purpose, straightforward, is this. Today's beautiful session is to educate us, empower us, and equip us on how to talk about, or what we talk about credit, registered account, what is good and bad credit, and then how it works, how to use it wisely, how to avoid the traps that leads to unnecessary stress. We'll look at registered accounts, which is a powerful tool. Many people don't fully understand how to take advantage of them. Good debts, moving forward, bad debts. Why do we do them? Why do we take those ones? And by the end of this session, you will have clarity and direction about what to go do practically. The Bible said in Hosea 4, verse 6, my people perish for lack of knowledge. Right? So if we don't know, we have issues. But if we know, we know. Amen. The next slide, please. Thank you. So credit score. I know I have a limited time. I don't know if we should ask questions after, or we should make it conversational. Because when we start talking, we might not have enough time to finish. But I will try after. Okay. Thank you. So credit score, simple. We've heard about it before. We all have one. It's like an identity here in Canada. We all have one. If you've not had one before, you will have one. Because you get a mortgage. And unfortunately for you, you have to buy a house. You have to rent a house. And then you will need credits. So you will always get credit score. And just 3 numbers. Simple. 3 numbers that ranges from 300, 500 to 900. That's it. Those numbers can make you and mar you in Canada. Those 3 numbers, your credit score, between 300 and 900, it can make you. You'll be so you'll love yourself, and then it can mar you in Canada. Straightforward, easy. There's nothing more than that. And then the higher scores, the better financial trust people believe in. No, you'll be so surprised how people say that. And then the Bible says in Proverbs 22, verse 1, it said, a good name is more desirable than great riches. Credit score is your good name. Full stop. Your credit score is your good name. So let's just take 3 seconds and just think about your credit score. Do you know your credit score? Okay, so 1, 2, 3. I'm not asking anybody, but you know your credit score. But let's think about it. How good is your name? How good is your name? Okay, all right. Let's keep going. Next slide, please. Um, how they calculate credit scores, and I try to do a beautiful graph there, and I made it's 100%. It's simple and very straightforward. Number one of it is payment history. Payment history is about 35% of your credit score. Um, Credit utilization is 30%. Okay. Length of credit history is 15%. Uh, Credit mix is 10%. Like what again? Must I use credit? And then recent inquiries is 10%. Okay, let me spend some time here and just talk about it a little bit. Payment history. You get credit, make payment. If you don't make payment, you are doing yourself. Like I said, credit in Canada can make you or mar you. Exactly. So you have to make payments. It's 35% of your score. Stop. I don't know if I have to express that further, but if you have questions, ask me. I can help you there. Um, Credit utilization. You can't just have credit card and not use it. Like it's like head and head when you're flipping a coin. Both sides is head. You have to use credit. That's the fortunate part of it. You have to use credit. If you don't use it's not good for yourself because your score might be lost, look a little bit dormant. But if you want to grow your score, you have to use credit. The length of history. This is one thing that most people fall victim of. We have credits. We get, for example, you get a credit card, and you're like, God, I want to be very disciplined. I don't want to use credit card anymore. And then you are someone like myself that listens to Ramsey. I don't know if you guys run Ramsey in the States. Oh, I love Dave Ramsey. Thank you. Wonderful guy, eh? He hates credits. Do you know why he hates credits? You know why? He's bankrupt before. Bias. Bias. But at the same time, it gives you tips. It teaches you tips. He hates it so much, but it gives you tips. It will tell you, cut your credit cards. Throw it away. And then we do, well, yeah, sure, cut it off. Throw it away. It's nice. But then it's good. It's very subjective. It's good. It will help you build the discipline. But if you close your credit card, that history for that credit card is gone. Yes. You lose 15% of your score. So you wonder, I've closed my credit card. And then you check your credit score 1 month after or 2 months after, your score just dropped. You're like, what did I do again? You did nothing wrong, but you just closed the account that you've had for almost 7 years, 6 years, 5 years of your stay in Canada. Gone. So the system will just realize itself and say, well, this person doesn't have this credit anymore. Bye. But you want to build, right? Aha. Another one is credit mix. You have to have a ratio of this credit. Credit cards, yes. Loans, yes. Line of credit, maybe yes or no. Not all. Then mortgages, you have to. If you're someone that checks your credit score often and uses these tools, usually tells you, they call it credit education. It will tell you there's some tips you can use to build your credit. I don't know if any of you have that. It will tell you some things you're lacking, right? Aha, thank you. That's it there. You need a little bit of twist in your credit. A little of a mix in it. And finally, recent inquiries. Oh, we are all guilty about that. You want to buy a car, you have the money, or you are at that place where your income can carry the loan. Then you go shopping. They call it go shopping. You enter Ford. Ford will tell you, I like you, ma. You're welcome. Sit down. They give you coffee or water. And then you have a nice conversation. Guess what you do? They do a credit check on you. Fortunately, sir, you don't qualify, but I have something else for you. And then you get up from there. That Ford cab. You go on ChatGPT or whatever you use, or Google, and you just, oh, AI, nice one. Toyota is now good. Oh yeah, Toyota, and I'm fine. Have a seat. Welcome. Coffee or tea? Oh, you have tea today, not coffee again. And then I like that your car RAV4 is good. Okay, let's run your credit. You consent to it right again. Oh, and then you go again. Well, like, well, you know what? Yeah, you don't qualify. They will not tell you what's wrong with your credit though. They will just do the inquiry because they want to sell. You go again to the bank. They will say, you know what? I'll recommend you go to your bank and see if you qualify for a loan. Am I speaking to somebody here? Am I sounding very familiar? And then go to your bank and you sit down again with that guy in the bank, an advisor like myself. I'm not an advisor, I'm a planner. And they say, hey, well, let's check your history. They check again. Guess what? You've done 3 different inquiries. That will hurt you. Yes, that will hurt you. I always tell my clients, most of my clients, 1 inquiry in 6 months. 1 in 6 months is the best practice. If you ever want to keep checking around, 1 in 6 months. But then unfortunately, so when you want to buy these cars, how can you go about it? What are you saying now? We need to buy these things. The best thing is make sure you work your numbers well. Get there. Don't just consent to them saying to check your credit. Don't consent, please. Just check it. Just do your work first. Go there, ask them, tell them what you want, but tell them, do not check my credits first. Work the numbers first. Then after that, they can check your credit. We'll go more and keep talking about that later. Can I have the next slide, please? So why does credit score matter? Like I said earlier on, it makes you, it smiles you, right? It does matter because it affects your loans approvals. If you have bad credit score or low credit score, you have no approvals for loans. It determines interest rates. You know, you come with a good credit, you say, two people go to the bank to get approval for a loan. This person tells you, my rate is 3.5. Like, I should get 3.5 also. No, sir. You will not. No, ma. You will not get the same rate. And the reason is because your credit scores are different. So the better your credit score, the better rates you get. If your credit score is not good, they'll give you bad. I don't want to use our words we use. They'll give you bad interest rates that you don't like. It impacts rental applications. So nowadays we see people want to rent a place. They will tell you, we will do a credit check on you. Bang on. There's nothing you can do. Influences job opportunities, yes. To the glory of God, I've been privileged to be an IRL of I've been an employer. I was a branch manager advisor at RBC. And you find a good candidate, lovely people, you like them so much, and then you go do credit check. Guess what? They will tell you can't hire that person. You have to start all over again. Why? Bad with credit. So, yes. So, some jobs, they will not tell you, and the best part about these companies is they don't have the right to tell you why they say no. They will just tell you, you failed credit, they'll tell you failed security check. Simple. So, credit score is very, very important. Please, I can't overemphasize it. That's all. Next slide, please. I have a few slides. I want to run down them because I know you all have questions. So let me keep stirring the water. Good debts and bad debts. Very common stuff. What is good debt? What is bad debt? You've been saying all this since a while. I'm sorry, the writing looks small, but I will try my best to read it out. Good debt increases net worth or income. For example, student loan. So whatever debt you take on that will increase your net worth over time. It might not be now. Over time, you can go for it. That is why we all get a mortgage. Because why? When you get a mortgage, it will increase your net worth over time. You buy the house today, it's 300,000. Over time, the house is worth 400,000, 450,000. It is good debt. Okay? It's good debt, but it's subjective again. I have to be very careful. Some people it's bad, some people it's good, but it's good debt. Yes. Bad debts, for example, are things that are very depreciating. Unfortunately, we don't want to hear it. Most of our car loans are bad debts. Most of them are. I didn't say all. Most. If you buy a car, It helps you to go to work. Is that not good debt? I'm serious. It's good debt. I have to go to work now, but I can't afford. But then you can afford, instead of buying a Tesla, you can afford what? $6,000 car on the street, can't you? Aha. Pick your choice. uh, uh, and then so there's good debt, there's bad debt for sure. Okay, let's go on to the next one here quickly. Next slide, please. So talking about good debt. So I was saying good debts are something that increases your net worth over time. Number one, for, for example, student loans in your education. So you need money to get better, to increase your net worth, to increase your income. Of a higher income, you want to write an exams, so you put the exam on your credit card. It's okay. Don't criticize you. Don't be too hard on yourself. Put it on your credit card. Write your exam. When you pass, you know your income will be higher. That's good debt. Often lowers interest. Well, most student loans are lower. Like they give you lower interest rates. Some loans out there are low interest rates. Take them. It's not bad. For example, when we spoke earlier on, we said you have to use credit, right? So student loan, for example, is tax deductible. Interest are. Some debts are tax deductible. Okay? Some debts are tax deductible, depending on what you use them for. So I can't begin to go into that because of time. The Bible says in Proverbs 1 verse 5, let the wise hear and increase in what? In learning. There's good debt. There's bad debt. So let's go to the next slide, please. Talking about bad debt, I said car loans, for example. You lose the value of the car, depreciating assets, high interest rates, long-term financial burden. Consider buying used car or what? Leasing. So sometimes leasings are good. Not everybody needs to lease a car. It's a little bit on the good side and sometimes on the bad side. But an example of some bad credits. Okay? The Bible said in Proverbs 22 verse 7, guess what? The borrower is what? A servant to what? To the lender. And that's credit for you. You have to be very careful of what debt you put on or you carry on. On the next slide, we'll find he said credit cards reasonable versus harmful. The reason why I put this slide in here is just because I know most of us talk about credit. We all use credit cards for sure. Sorry. Okay. All right. Let's do that. All right. Okay. All right. Thank you, Ma. Okay. All right. Let's stop. Okay. This is actually my last slide here on credits. So what I would do is, okay, we'll dwell on this one and then we'll ask questions and I will probably go back. And I will go back. I will go back. Okay, okay. Okay. All right. God will help me. Okay. 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 All right. I'm happy we're even here. Okay. So we'll just do all here. Talk about credit card and then we'll go back. We'll talk about everything again. Thank you so much. All right. Credit cards. Let's dwell on credit cards. So it can be very responsible and very harmful to use. First up. It's a powerful tool if you use it very well. Um, let me explain credit cards a little bit to you. It's one of the easiest credits you can get. One of the easiest you can get. And the reason why I said easy because they don't use a lot of your what I call your income to determine your credit. They determine a little bit, but it's not high requirement. For example, mortgage, we have a golden rule for mortgage. Okay, for a mortgage, your We call it debt to income ratio, must not be more than 42%. That's for sure. But a credit card, we can still be a little bit of a leeway around credit cards. Okay. So you get a credit card, good for you. How can you use a credit card to help your credit score? Number one, most important thing, pay attention to your statement. Pay attention to your statement. There are two things, there are always two balances you will always see on your credit score, on your credit card payment. Who knows the first one? Available balance. No, I mean statement account. I know available balance is there. Dates, minimum date, due date, yes. And your statement balance. Yes. Those two things are different. They're different. If you keep paying your minimum balance, minimum payment amount expected, you will have good credit score. Good credit. Yes. If you pay the minimum amount, so you expect to pay $10 every month, or $25 or $35, you pay the minimum amount every month, you have a solid credit score. Yes. That's the rule of thumb. That's normal. That's okay. But then that statement balance, that one, if you don't pay that one, they will charge you interest. There is a grace period, right? Let me repeat myself. Thank you. So you will see two key balances when you get your statement, right? And statement balance. Yes. That is statement balance if you don't pay it on the due date. But the minimum amount, you must pay it on the due date. It's very, if you make payment on the due date or before the due date, you have good credit score. That's normal. But then the statement amount, there's a particular time you must pay yours. We don't have the same time for that. The reason I said that is because we have different grace period. 21 days. Yes, that's rule of thumb. So you get your credit cards today. This is the 14th or thereabout. I don't know the day. I can't remember. 21 days from today, they will tell you you must pay the minimum balance at a certain date in between. And then there is now going to be a time where you get your statement every month. Okay. For someone like myself, I get my statement for my credit card on the 16th of every month. So what can I do to avoid paying interest rates? I have to pay the statement balance before I get my statement for the next on the 16th to avoid interest. Okay. But to have good credit, I must pay my minimum amount before the due date. In that part. That's it. That's credit card for you. That's the 411 for credit cards. So those numbers are very important. You pay the minimum amount at the date you're told. The statement balance you must pay before you get your next statement. That's it. So to avoid interest, that's all. You're just avoiding interest. Yeah, that's the only thing you're avoiding. But if you do, sometimes you can't afford it. You can't afford the whole balance. You can pay small, no problem. But you incur interest. That's okay. That's not the end of the world. But the most important thing is you want to make sure you have good credit. So what do? Pay the amount. That's it. All right, guys? Which is fine. No, we can actually have a conversation now since we have more time, eh? Yeah, so, yeah, which is fine. You can pay more if you want to. It's not wrong. Okay? We can dwell on credit cards a little bit, and then we can use that to rally around on other questions. Actually, line of credit.
Thank you very much. Thank you very much.
Go ahead. Listening. So he said line of credit. Yes, I'm good to go. Line of credit. Okay. Line of credit, it's quite unique. Okay. It's best ones we always recommend for most of our clients. The reason I recommend that is because it have the least interest rate. It's expected to have the least interest rate. Most of the time, there's what we call secured line of credit and unsecured line of credit. Okay. Sometimes you come to the bank and they tell you you are pre-approved for a line of credit. Right? You've heard that word before, pre-approved. When you hear pre-approved, ask them a question. Are you checking my credit or am I accepting today? If they say they're not checking your credit, accept it. Why? The bank is giving you money for free. Okay, ask the question. No, some people are worried about you, but I'm talking about line of credit for now. Let me not go around. So line of credit, we always they always, most of the time, pre-approve you for unsecured line because the limit is not more than 20,000, sometimes 15,000, sometimes 30,000. Even some people, if they understand your bank trusts you so much, they might pre-approve you for something higher on the line of credit. It's because it lasts less interest rates. It's good. But the line of credit, you're only expected to pay the minimum amount. That's the only, if you keep paying minimum amount on the line of credit, you will have good credit, okay? But you can carry the same debt from January to December 2035. Oh yes, sir. You're paying your minimum amount, good credit, but you have not paid the real principal amount you're owing. That's the risk of line of credit. It's very dangerous to have, but we always give people because it's easy. It's not as good interest rates on it. So you have a line of credit now. What do I recommend? Use it more like an operating account where money comes out, you pay back in it. Okay? Use like an operating account where money comes in, you use it, I pay it back. But you must pay, I repeat that, the minimum amount at the due date. It's very important. Most line of credits will always ask you to pay either at the beginning of the month or at the end of the month. Yeah, it's always beginning or the end, not always in the middle. Beginning or end of the month, line of credit will ask you to pay. But minimum amount is required to have good credit. But the rest you pay as you want to pay. The secured line of credit is always tied to something. Either landed property, a mortgage, a car, or something. That's what we call it secure. That one we can go higher limit. So you can have a mortgage, okay, that also has a line of credit attached to it. So then they can give you higher limits on those ones. So you can, but those ones oftentimes are always whatever limits they give you plus what we call prime or plus prime plus either 0.5 was plus 1 or something like that. The line of credit are always very good. They're good. They're very good. But use it as an operating account. Don't use it like you're using like a loan. It's just dangerous because of the interest rate. You can owe from now to forever. You're just paying minimum amount. They will let you pay that one forever. But don't use like a loan. Use it like an operating account. Thank you. Did I answer that question very well? Do you have any questions? Okay.
Thank you very much. Just so that we coordinate the question and answer.
No problem.
Thank you so much.
Welcome.
I wish we talked about you just focusing on credit. So many important things you said at the earlier part of your slides. Media, I don't know if you could go back to the beginning of the slide and just run through so people can see it and remember questions. If you have any questions, please just because I don't think there's any need to write it down. Okay, so I would take the mic from here. Let's just be very fast. So I'm looking at both of you.
Thank you very much.
You're welcome, man.
You said it is good to take the pre-approved line of credit.
Yes, ma'am.
At the same time, I saw it at the beginning of the slide that you said utilization also matter.
Yes.
Okay, so if you don't get to use it, you were pre-approved, maybe by 3 banks, 4 banks, and you don't get to use it, won't it still affect your credit score?
Okay, good question. I like that. Thank you for asking that question. Yeah, so I like that. So you are pre-approved for any form of credit. You accept it, not only line of credit. You could be pre-approved for a credit card increase, a loan, anything. So you accept it, but fortunately, you don't have to use it, right? Yes. Utilization of credit is good, but at the same time, it doesn't have negative impact. So it's one of those credit stuff that doesn't negatively affect you, but it will not positively affect you. Does it have impact? Yes, but not negative, only positive. Okay, so you have the credit, yes. You don't want to use it, good. It will not increase your score, but neither will it decrease your score. Okay, you guys are there? Pre-approved, which is where I was going to come again to that. Pre-approved, they did not check your credit score to give you that loan. That's the blessing you have there. There was no recent inquiry done to get what we call a trade line. So each time you have Capital One, Canadian Tire, TD Bank, Scotia Bank, we call each of those ones a trade line. So was an inquiry done to get a trade line? No. So that's why we always recommend accept the pre-approvals, because no inquiry was done. Yes, there's a trade line, good for you. Credit history, length of credit usage, but you're not using it every day, also good for you, but will not positively help you to just stay dormant. Yeah, but no negative effect. Yes. I hope I answered that very well. All right.
Uh, Thank you for the session. My question is regards student loan.
Okay.
For example, you gain admission and you apply to Manitoba Student Aid for loan and grants. Does it impact your credit history?
Yeah. Good question. Was an inquiry done to approve you for that credit? Did they make an inquiry?
I don't think so.
They don't do that. There you go. So as long as there's no inquiry done, it's more like a pre-approval,
No.
right? Standard approval. There's no inquiry to go. What it will do is once you accept that student loan, it becomes a trade line on your credit. Okay? That trade line creates called credit history, gives your credit boost when you use it because you use it, right? So it creates that credit utilization. Then it actually boosts when you make payment. So it's like you're winning 3, 4, 5 ways, but you did not make a negative impact. Inquiries.
Like, so if you want to, like, maybe if you're on your mortgage, do they check for that, or they don't have anything to do with it?
So I have to be careful here because of guidelines. I don't know how each grant operators work. Okay, I don't know their policies. I've not worked at the other side of the government, but I'll tell you from the bank's perspective. Okay, so I don't know if the government always check your mortgages and all those things to approve you or pre-approve you for a student loan. I have no idea.
No.
I will be clear about that. I don't understand. I don't know if they use that as a standard to approve you for a student loan. Okay, but will a bank use that to approve you for a student loan? Yes. So for a mortgage. Oh, sorry, I didn't get the answer then. Yes. It's part of yeah. I'm sorry about that. Let me come back. Yes, my bad. It is part of your credit. Yes. So it affects your income. So there's what we call debt to income ratio for everybody. So there's the amount of debt you carry divided by your income monthly or annually. So that amount of debt is not just even your total debt. It's the amount you pay monthly. So how much do you pay in debt monthly divided by your income? The golden rule is that it should not be more than 40%. So if you're spending more than 40%, and they used to use, guess what, before taxes. So I'm telling you. So yeah, before taxes. So we want to approve you for a mortgage. And you say, I'm earning 120,000. Good for you. And then you pushed everything. You have so much debt. When they do the calculation, they will use your 120,000 before your taxes to approve you. But that's not actually what gets to your pocket. Don't get that. So that's one mistake we all fall for. They will tell you, oh yeah, you're approved. Okay, based on what calculation? Is it my gross or is it my net? Okay, so yes, your student loan will affect your application for mortgage for sure because it's debt that you carry. The most important thing is there are many tools out there that we can use to calculate your debt ratio before you go to a bank and apply for a mortgage. Yes, so they will use it. Yes.
Oh, okay.
Thank you for the clarification.
I hope we're all okay with sleeping in church today because I don't want to hear that you close late today.
Okay. My question is on credit utilization.
Yes, sir.
Is there any threshold for credit utilization for you to have good credit score?
Thank you, sir. I like that question. Yes, there is. I know again. Aha. Credit is always very, very, we'll call it boomerang nature. Yes. The golden rule again for credit utilization again is most people say 30%. I don't know what the golden rule is because I don't work for credit. I don't work for TransUnion. Okay, I don't know what they do on their own side. But as someone that approves people for loans, okay, we recommend that you should not go beyond 30% or 35% of your credit card usage or your loan usage. Okay. No, per card, per one. So, for example, I know that's why it's a little bit complicated. So that's why you see some people, when they pre-approve them, they accept it. So let me use this golden rule now. I have a credit card of $1,000. Okay, 30% of that is $300. It might not be good enough for me, right? But if the bank pre-approves me for something higher, say I have 10,000. Okay, 30% of 10,000 is $3,000. How about now? $3,000. So you're using less than 30%. Okay, so that will give me good credit versus the person that's using $900 of $1,000. You see that? So that's where it becomes a thing of negative reports. Well, because you're thinking you're maxing out your limits. So that's why I tell people when the bank approves you or pre-approves you for a limit increase, take it. Not because you want to use it, but because you to push your credit utilization limit. So there's a golden rule. Some people say 30, some people say 35%. I don't know what I would answer you. I don't know which is the best golden rule, but I would say use 30%. Okay, use 30. Don't push the limit.
Thank you very much. I just want to say that please also listen carefully. If somebody has asked your question, like what he answered just answered her question. So let's just be mindful. I have a question here that says, two questions. Can you explain the effects of store cards? Like when you go to Walmart, we all know as you are checking out, they're telling you, do you want a card? Do you want a card? So effect of all those Walmart, Costco cards, and then the effect of accepting increased credits. Like you said, maybe you had 5,000 and then you just open your bank app one day, they'll tell you you've been pre-approved for $20,000. Does that affect your credit? And then the store cards, how does that also affect?
Maybe from superstore. So what's the effect of that? So does it make you look bad in the credit world?
Questions. That's a different question on its own.
Yeah,
So let's come back to your balance transfer, sir. So the first question, remind me, please. Ma, remind me the two questions again. Let me answer.
The first question is, what are the effect of store cards, Walmart cards? I know Walmart is there's always a funny story to that one. Walmart, Costco, and then effect of Canadian Tire. You see, everywhere you go to be. Then effect, that's the one. The second one is effect of accepting increased credits, like from 5,000 to 20,000. But I think
yeah. So let me start with the second question and go back to the first one. So when they pre-approve you, I said something earlier. I don't know if you guys catched it. Make sure they are not doing inquiries to give you that limit. So if Capital One sends you a mail, say been pre-approved for 7,000, they are going to do inquiries on you. Are you getting that? So don't just say the guy said that every pre-approval should accept it. You go and accept it. They will check your credit before they give you that one. You get it? So please, cavity. Okay, Pastor, thank you. I said it, I clearly said that. So if they are pre-approving without checking your credit at all, that is what you accept. Okay, that's the only one you accept. I will stand behind that one and say that clearly because of credit utilization. Now, if Walmart is offering you credit, will they check will they make an inquiry? There you go. That's why I started second one first before the first one. Capital One, Canadian Tire, Walmart, any one of them will do a credit check before they approve you. Okay? Before they are not pre-approve you, before they approve you. So you have to be careful. if you are willing to take it, like I said, one every 6 months if you have to. Okay? If you're willing to take it, go for it. Okay? There's no real negative effect in general because you shop at Walmart, you to pay for the groceries, you get points for it. That is good for you. Okay? You use their cash back to call back your card. It's look good. Costco, they do the same thing. It's a win-win everywhere. But the most important thing is still the same rule. Pay your payback. Thank you, ma. You know, you are using their credits. Lovely. It will boost your credits. Okay? The trade lines you are having, no problem. But make sure you are making sure that you're paying your payment. You're making your payment, sorry. You're paying everything. You're doing that back to back to back. Those golden rules apply. Minimum payment, statement balance, a key. That's it. So it doesn't matter even if you take all. It's okay. It's not bad. And then balance transfer. Good. Balance transfer on its own is different. Totally different. You're just moving from point A to point B. You know, they'll give you promo and say, for the next 18 months, we will charge you $0 on the interest. The catch. Interest rates. Does it work for you? Yes. Move. Okay? Can you pay it off within that 18 months? If you cannot, why did you move? Though you saved interest for 18 months, but did you pay it off within 18 months? Because guess what? The result back to the 22.99 or 20.99. That's your interest charge. You get it? So you're not carrying that balance that you had on card A on just card A. All right? And another one again that affects transfer of balance is this. The limit. When we said earlier on, 30% is the golden rule. Not compulsory for you to stick to it. So for example, you have a Scotiabank credit card, you have 10,000 on there. You have not used the balance. And Scotiabank is offering you balance transfer free for 18 months, 0%. Good. You brought all your credit card debts everywhere and transferred it to Scotiabank, and that brought your total usage on Scotiabank to $9,000. 9,000 over 10,000 puts you at 90%. Is it negatively affecting or is it positively affecting? Negatively. There you go. So that's the advantage there, sir. So it's very logical. You have to be very careful when you do balance transfer. Don't increase your limits too much, but make sure you pay off within that period of time if you have to. And also, I should not say it's wrong that you go beyond 30%. Please, you can go beyond 30%. You can go beyond, you can go 75. You can even go use 100%. Yes. The issue is not using it. The issue is not using the credit. The issue is what?
Paying back.
Thank you. So then, like, let me recap a little before I answer another question again. Say you have a credit card this month now, okay? You used the old $10,000. Before they give you your statement balance, you've paid down some of it, right? You went everywhere, you did your shopping for the day, and everything equals to $10,000. You get back home. Do I want this 10,000 to report on my statement balance or not? You pay it. It might take you 2-3 weeks to pay it, but pay it down so that before you see your statement balance, because it's after you get that statement balance that they report to TransUnion. You get it? So before they report to TransUnion, reduce the payments. So using it is not the problem. It's making sure you are smart about when to make payments and when not to make payments. It's very key. Am I making sense here, please? All right. Thank you.
So yes. So sorry, because we have to move. I've left. Okay. Okay. It's her turn, but just
Don't worry.
because
By 2 o'clock we'll go home.
I will give my president my microphone before they ban me from a meeting. But before I just want to add to. I think there's something regarding the balance transfer.
Yes, ma'am.
Based on what you've taught us.
Yes, ma'am.
I just want to also remind you that if you move that transfer, you are closing your oldest credit.
Thank you, ma'am.
And that affects your. I'm a student.
There you go. I like that. Everything comes together. Everything comes together with credit. Thank you. Yeah.
Hi. My question is about cars and like the dealers and everything.
Yes, ma'am.
You did say something like if you're the dealer, instead of you going to like each dealer and they're doing a credit
Check.
check,
is what do you think about going to the bank instead? And like, what's the process? Can you go to the bank instead of going to a dealer?
Mm-hmm.
And like, what is the process and stuff like that? And also, my next question, for this bank transfer, like, does it also like apply to like consolidation or something? I don't know. If it applies to
Yeah,
this.
I know what
Yeah.
you're talking
So,
about. Okay,
yeah, those are my questions.
thank you. So, consolidation is another different ball game. Okay, we're going for credits, different kind of credits, right? I should have done that earlier on because of time.
I will find
So,
it.
balance transfer doesn't go into consolidation, but it's also typically kind of consolidation. When we tell you consolidation loan, I'm actually that first before I go to the first question. Okay. When we say consolidation, we're saying we are closing all your loans everywhere and opening a new one for you. It's not bad. It's just we use it as a tool of what we use it as a tool that will as a tool to manage your debt. Okay. People are stuck. Instead of paying 10 different credit cards, which you should not have up to 10, God have mercy. But okay, if you choose to have, that's fine. If you cannot afford to pay 10 of them simultaneously, you just want to close them all and open just one. That's what we call consolidation loan. Okay, so almost close to the balance transfer. But the balance transfer, you must have the cash available on one card to move it there. Whereas a consolidation loan, the bank will close everything and give a fresh loan where you pay from the balance, say 50,000 to zero. You have a time, you have an amortization for that. It could be a 10,000, 10 years, 5 years amortization for consolidation loan. Okay. Oh yeah, it goes down. Yes, it's like a car loan where they close everything up. They give you a consolidation loan. We consolidated everything for you into 20,000, and then they give you instrumental, sir. Yes, sir. Instrumental payments. So you pay down from 20,000, 30,000 to zero. Is it good? It's good sometimes. Sometimes, because you're closing the streets, you're doing everything, but it kind of eases the burden. But then it prolongs your payments. But there's something we also say. Most of those loans are open. Constellation loan is so if you have more cash flow, okay, you're gonna make me wear my financial planning hat now, which is cash. If you have more cash flow, you can choose to allocate your cash flow where you want to allocate it to. That's the help that consolidation loan gives to you. It gives you a breather, right? But you have to be disciplined again to help. Now back to the first one, dealership versus bank. Okay, I don't do loans a lot like before, but the banks will qualify you, yes, okay, but oftentimes our rates are always higher than the dealership. Full stop. So yes, you come to me as an advisor at the bank, I will tell you go and try the dealership first. If they decline you, we might even come in and help you. So then that will not lead to call a secure loan. But most of the time when you go to dealership, when they're checking your score and they'll tell you which bank do you bank with, right? Because they want to link that loan to your bank to see if your bank will qualify you for it. Okay, so if your bank will say yes, they will give you the loan. If your bank will say no, another bank will say yes, they will give you the other bank's loan. That's how most dealership do it. They shop around for the best deal and offer that to you. Does that answer your question? But you know you're gonna have more. It's credits. Trust me, you will have more. It's a big stuff.
Thank you, sir.
You're welcome,
For
ma.
all the sections, we really appreciate it.
No problem.
I think that the next time maybe we will have this on Saturdays so that we can have time to. So my question, thank you for explaining more about the credit consolidation.
You're welcome, ma.
Does it have impact on your credit score? I want to ask that question. Then the second question I have is, well, you've not talked about the secured credit card. How does it work?
Okay.
Because I was one in a program and they were telling us that if you have, maybe you have kids at home like 16 years, 18 or thereabout, that you can get secured credit card for them. So for them to be able to build their credit history. So I need more information about that secured credit card. And then the credit consolidation, does it have impact on your credit score? Thank you.
You're welcome, man. Let me start from the secure. No, let me go from consolidation and then I'm go to secure credit card. The consolidation, yes, you will lose length of credit history, but 15%, okay, versus payment history 35%, versus credit utilization 30%, versus credit mix. You know, you have to pick it. But will I tell you categorically, help you? I don't know. And the reason I can't say I said I don't know is because of cash flow. The reason I would recommend consolidation to you is because of your cash flow. So you're paying interest. So you owe 5,000 year, 5,000 year, 5,000 year, 5,000 year. Different interest rates. So you're paying different payments on each one, right? What if you close all together to become 20,001, and I give you a lesser interest rate, lower interest rates, and I prolong it for a long time? That means that instead of you paying, for example, say you're paying 250 on each one every month, you only be paying 150 on the consolidation loan. So you have extra $100, right? That helps your cash flow. That's the most important thing about consolidation loan. It's all about cash flow. So it helps give you more space in cash flow. Then use your cash for other things. But we always recommend when you consolidate, save the extra money. That's why I was thinking account, but it's okay. Save the extra money that comes out of it. Or you use the extra money that comes out of it to pay down the consolidation loan. So you pay it faster because it's open. There's no limit to it. Okay. They answered that question very well. Yeah. So, and then when you talk about secured loans, credit card, yes. Secured credit card is a way the bank use, not bank always time. The bank sometimes give you secure credit cards. Some financial institutions do that so that because they don't trust you, in quotes. Okay, if people have bad credit, they will say, give us $1,000 of your money. We will hold 1,000. I will give you $1,000 credit card. Just in case you default in that 1,000 credit card, we'll use your 1,000 I gave us to pay it. Even if there's interest that you owe on top of it, we'll forgive it. That's it. So the idea is they're taking your money, they're holding your money to secure the credit they want to give to you. That's it. Does it help grow credits for the younger generation? Yes, it does. If you can afford, but don't forget, you're keeping money somewhere. It's not growing for you. Inflation is coming into it, but okay. If you have to, go for it. If you don't have to, you have to do it. Yeah, but is it good to help grow credit? Yes, if you afford it. You can start with $500. So secure $500, give them credit cards, let them use it. Teach them how to use credit. Because on the long run, it will help them. Yes. Secured credit card is good, but it's just you putting money somewhere.
All right.
Cover.
Thank you.
You're welcome, sir.
I have two questions.
Go for it, sir.
You talked about the credit number that ranges from 300 to 900.
Yes, sir.
My question is, what is the minimum number that you must maintain for you to have a good credit score? The second one is that I was somewhere and they were talking about that it's better for you to be using your credit card, like regular spending, rather than using your checking card or your that build your credit score. How true is that?
I like that questions. Those two questions are good. You know why I said that? I smiled when you asked the question. I thought about putting it on the slide, but I'm like, there's too much to cover when it comes to credit. There's too much. So I'll start with the second question. Yes. So, second question. And should I use it more like a daily? No. So that's the second question. The numbers, yes. I'm looking at that. I want to see how to answer that question. The first question. The first question. Oh, there is no guideline, but I will say something here. The prime banks, Scotiabank. I'll start with Scotiabank because I work for them right now. Scotiabank, RBC, TD Bank, CIBC, BMO, and all that. The prime banks, they have their own limits. I'm not legally allowed to tell you. I don't even know the limits. Okay, I don't know it because I'm not a credit person. But that's for you, even if I know it. Okay, but then is there a reasonable limit amount? You yourself will know it because if you are using credit and you're checking your credit history and you see your score is around 600, 500, 500 and something, 400 and something, you are seeing missed payments. You're already seeing missed payments. You're already seeing your inquiries. Allow me to say that. You're seeing it. Those are the things that will affect. So once your score is around 400, 500, you're seeing those signs. 600, 700 can be maximum credit. 600, 700 can be maximum. Say you're using about 90% of everything. That can be borderline 600, 700 based on my history of you of seeing history of credit scores. 800, 900 might just be you're paying it. You're using it, you're paying it, using you're paying it. You've never done any inquiries in the last 2 years, 3 years. Solid score. So there is no benchmark, sir. But I would recommend, go help also above 700. Stay above 700 if you can. If you cannot, build yourself to 700. Can you build your credit? Yes, you can. Say that here, right here. Yes, you can build your credit. Takes you about 6 months to build your credit back. That's why I tell you, if you do an inquiry once every 6 months, because 6 months is enough for you to build your credit back from wherever you are to where you want to be. Okay? 6 months is solid. And then second question, should I use my credit card as a daily transaction? The answer is yes. Yes, use it. The reason I would say that is because of insurance. If you use your debit card to buy something here today, okay, and it's fraudulent, the chances of the bank giving you your money is 50-50. The bank might not give fraudulent. I know, but yes, okay. But if you use a credit card, it will give you your money back almost 100%. So, is it good to use your credit card to do your purchases? 100% yes. It is. It's secured. That's one thing I will talk about it. Security, that's all. And then, like I said earlier on, just make sure you reduce the payment before you get your statement balance. So that it doesn't report maximum usage. And then even if it does report maximum usage, make sure you make your payment before they charge you interest rate. Thank God. So the more you use, you pay. Yes, that's it. A question, sir. Beautiful. Thank you.
Yeah, he just answered some of the question, but we still have more. Let's take for instance, you're just sitting and your bank sends you a message saying you have been pre-approved for let's say 30,000 line of credit. You did not ask for it, but when you saw the rate, they now said okay, the rate is prime rate plus 4.8. Yeah, let's say 4.81 or 4.82. And to you, you think that rate is high because prime rate might be 4.5 and their rate is plus their rate, which is 4.81 or something. That's 8 point, almost 9%. I think that is high. Because I did not ask for it, can I request that they reduce their rate for me? I don't ask for the line of credit. You offered it to me. Can I call the bank back and say, okay, you have pre-approved me for this amount, but I think the interest rate is too high for me. Can you reduce the interest rate for me? Is that something that is possible? Or you just accept it because there's a timeline you need to...
Yeah, good question. Thank you very much for that. The answer to that is yes, you can ask them to reduce the interest rate. But as call application for a new one. For a new loan on your own, which you might not qualify or you might qualify for. So for them to reduce that interest rate, for you to get good interest, you have to have credit, right? So if you believe your credit score is good, like you're on the 900s, you're on the 800s, oh, lovely. You can step in and let's reduce this interest rate. Do an application. I'm confident I'll get a lower interest rate. They'll do it for you. But that's an inquiry for you. But if you accept it, accept your approval and move on. You can accept it, you might not use it, you might use it. Choice is yours. It's always very subjective. Okay? But if you ask them to reduce the rate, they will reduce the rate. But they have to do an application. That's the direct answer to that question. Do you have more questions?
Yes, please. Thank you for your time. I have two questions. The first one is that I've seen people put in their credit card in ATM to take cash. What advice do you have for such people? And my second question, I really don't know if it's related, but I will ask it anyway. If you cannot answer, that's fine. So the second question is that when a debt goes to collection, is it true that the collection company does not have the right to be calling the debtor? Because like I heard, I came across an information online that says the debt has been sold, and so they do not have the right to come after the debtor to start. And because they are very aggressive, they will call, they will make all kinds of threats to just make sure they get the money. But this person was making this video online saying they do not have that right to do that. Is it true?
Okay. Wow. Yes. Um, it goes to collection. You lose legal standing to stop. They've sold your debt. No doubt about that, man. Or not you, like the situation. They've sold the debt, yes. Legally, can they harass you? They can harass you. They're allowed to harass you. That's the one thing about it. The law allows them to harass you. Can you pick and negotiate? So that is where we come in and tell you. I tell my clients, pick the call, negotiate with them, tell them how much you can offer, okay? Because their job is just to collect from you, okay? What can you give? Just work with them. If you cannot, it's unfortunate, but you just have to. Okay. The first question was about withdrawing cash advance. Cash advance is a big no-no. The reason for that, they charge you daily interest, not monthly like the other one. So they charge you daily interest of about 22 points, I think 22.99 or 24.99. It might vary based on the bank or based on the financial. Some people might be higher. So it varies. Some people with 24, some people is higher, some people is like lower, depending on what credit you have. But cash advance, we call it cash advance, which is going to the ATM, taking cash from a credit card. Please no. Yeah, because it's daily interest rate. If you can afford it, please don't do it. But if you cannot, it's okay. But please pay it back that same day. Because they will charge you interest rate on it, and it's very high, and it's daily.
So, if this question has been asked, so the first question is that what's the difference between soft credit check and hard credit check? And also, I recognize that you have been exposed to small financial institution like Easy Finance and also one of the larger big boys, which is Scotiabank.
Okay.
And which one of these institutions do hard versus soft?
I like that. Thank you. The first question, what is soft, what is hard? Oh, wow. So soft credit check is the one that your bank does that you're not aware of. The one that qualifies you for the pre-approvals. You get it? That's what I'm saying, collect it. Because they can see the way you use credit. They are allowed to do those soft checks. It doesn't show up on your credit history. Okay? It doesn't impact you at all. But when you're walking to an office and they're telling you, we'll just do a soft check. I don't believe that. Because you must have a relationship with that person first before they can do a soft one for you. That's what I'm just going to say. Existing relationship enhances them to do a soft one. But most applications will be hard check. If you're the one seeking the loan, it's always hard. I don't know how they want to make the promises for you. Because you're seeking, and that's the way we can know debt seekers. The more inquiries we see, the more we know this person is a debt seeker. Full stop. So you don't want to go searching. Okay. And then when it comes to the second question, sorry, help me understand the second question again. Soft question. Do better. Yeah. Okay. Thank you. And I think my knowledge today that I'm using here for you guys is from Easy Financial the most. You know why? They give high interest rates, like crazily high. I worked with them for a while. I don't know if anybody works with Easy Financial. I'm not putting any company down. I'm sorry. It's just condition. I had to do it because of papers. We are immigrants now. They offered me the job, and I needed work experience. But I learned a lot there that has helped me in my career, because they sell credits of about 46.99, 30.99. Easy Financial. It's higher interest. It's the idea of cash flow. It's not nice. You're paying high. Okay. I won't recommend it literally. But like I said, it's very subjective. You get what I'm saying? What do I mean by that? You were expecting a pay to come in on Friday, 10,000. God forbid there's a quick emergency today, but you're starting as money on Friday. Okay? If you get that loan, most of their loans are open, so you can get it today and close it tomorrow. Okay? So if you need it that bad, and that's the only place you can get it, only place you can get it. That's what I said though. Only you. God forbid, God will not allow us to be in that kind of situation. Okay? But the idea is it's very expensive. Okay? They all do hard checks. Nobody really do soft check. If you are the one seeking the debt, it's gonna be hard. All right? So put that in the back of your mind, even if it's prime banks, not prime banks, whatever. Most of the prime banks don't usually give high interest rates. They would rather tell you you are declined. Okay? The prime banks will just tell you, we decline you. Go here, go in peace. Just go. Just go. Whereas they'll just tell you go. We can't give you high interest rates. We can't take that risk. Whereas the loan sharks, the people around, permit me to mention their names, a few of them, cash money and other things, areas like that, they will give bad debts, good credits. The idea is to rebuild if you can, but the cash flow is expensive. It's too expensive. The cost is too much.
Thank you so much. I wish I can give you another bottle of water because you have spoken so much today. God will bless you. Just before you go, I just have, these questions are just very short. The first one is, you've said it over and over again, if they do hard check, it's going to affect your credit score. For every hard check, which English level? One number, what points would drop from your credit score? What's the average? Somebody wanted that question.
Will I be a Gen Z?
I know. Yeah, no, so you really don't
I'll just
know.
be a Gen Z.
You can't.
No,
Okay.
there is.
Okay.
I'll answer that directly. Will it impact? Yes, but
you don't know how many points.
the reason is because your credit is being analyzed monthly.
Mm-hmm.
So even if you say it's 10%, other factors affect also. So inquiries. But there's a rule of thumb out there. Let me give you a cheat code. I don't know if it works, but don't quote me, please. People will say if you want to do a check, do it within 30 days. You know why?
Do everything within 30 days.
You know why?
It's going to be that month.
Before they update your credit history the next month, you've done it within 30 days. But be careful if it crosses end of the month. So if you start doing your window shopping on the 29th, I'm sorry, by the time you see your next history, it's already bang, exactly, it's already down. But within 30 days, there's a rule of thumb that says you can do your shopping within that period of time. And then don't go from bank to dealership to Easy Financial to cash money. Stay within the institution. So if you're doing cash shopping, full stop. If you're doing prime bank shopping, full stop. It's one thing, yes. But for that institution, that's the rule of thumb there. I can't give giving all the secret out there. but I've given a lot. I've given enough.
Oh, you've given a whole lot.
I've given
and
enough.
This is not part of, I just want to say that there are also apps you can download. Like I use Credit Karma to constantly check your credit score.
Yeah.
Sorry? Or Borrow Well to be able to, it's soft to check your credit score and be on top of it.
Most banks allow you to check your credits right away.
Yes,
Yeah.
yes. Even on your bank app.
Yes.
So it's one of the things you want to monitor also.
Yes.
And then the second question here, very briefly, is asking, do children need credit score?
Children, no.
No, so children don't need credit score.
So this is one thing here. Another thing again is you don't have credit history until you are 18. So that's no. You don't need it. I don't know about US, but in Canada it's illegal.
Okay.
Yeah, to give somebody less than 18 years. I'm very sure because there's a requirement. I don't know if it's 16. I don't know if it's 16. So I know they might get some soft ones. Is it 16 or 15? Yeah, because secured credit card 16. Okay. But non-secure, I'm very sure it's 18.
Okay.
I'm very sure it's 18.
Then we're rounding up. The final question is so we just want you to speak briefly on HELOC.
Okay.
That's the final one.
Okay.
No more question. Thank you. Please scan the barcode.
You can scan my barcode, please. That's why I kept it on every slide because I was expecting this. I was expecting this from the very beginning. It's not scanning.
We'll send it on the church platform. We'll send it on the church platform.
It's not scanning. I'm sorry. Oh wow. Okay. um ELOC. So different. I think ELOC is used by TD Bank. I think so. Some people don't call it that. So some people call it. Some people that bank with RBC will call it. What they call it? They call it that one again. Home line plan. So call it different names depending on the banks you bank at. But this is it here. An ELOC is called an home line of credit. It's a home line of credit that's attached to your mortgage, that's attached to your property. That's all. It's a secured line of credit. Okay, so but it's secured by your property, the mortgage. No, not the mortgage, the property. Sir? Yeah, it's secured by the property itself. So it's the property that secures the line of credit. And this is how it works with the line of credit, the home line plan, which we like is this. The more, so when it's, so for example, let me explain it this way. If you open if you get a mortgage today, and you put down more than 20%, okay, they will always oftentimes pre-approve you. They will always recommend you have an home line plan, which is called ELOC, okay? The reason is because you have equity there that they can access. So when they're pre-approving for a mortgage that is exactly 20%, they will not want to give you that because the rule of thumb says we can loan, the loan to value must not be more than 80% of the property value. Okay, I don't know if I'm sounding more like a banker here. But the idea is this: once you get your mortgage, number one, the line of credit get attached to it. The more you pay down your mortgage, the more the line of credit begins to increase. Okay, so if you pay down 10,000 of your mortgage, you have 10,000 to use as a line of credit. That's the advantage of it. So you pay down your mortgage, you have line of credit available to you. The advantage again to it is that by the time you pay down your mortgage, you don't have to go to the bank to ask for loan. You can just use your line of credit when you need money and pay back your line of credit without the approval of the bank. And some banks, they call it step. Like Scotiabank call it step. Where they give you a step, it's called step in Scotiabank. That's what they call it. Same process. Thank you. Any questions, guys? Any more? Thank you so much. Please, let's pray. Let's pray, please. Our Father in heaven, in Jesus' name.